So I guess, first of all, how much of this was Nvidia? I mean, Nvidia was quite a phenomenon in the equity markets this week. How much of what we're seeing in the equity markets is really because of the Nvidia effect?
So it's Nvidia, but it's not just Nvidia per se, because what Nvidia represents is the next growth leg of corporate America, of productivity, and of earnings for the fastest growing companies in America. So yes, it was that one company, but it's also what it represented in that the AI revolution looks to be real. The growth is spectacular. It won't be the only company that benefits from. So there are creators and they are benefactors from this, and so all that went into the Nvidia story. So yes, the numbers were terrific. They beat a high bar, right? They beat a high bar. I mean, it's remarkable that the market rallied, but the earnings were good. The outlook was great, and so that just rallied the whole complex related to AI.
There's been concern that the market's a little too narrow. I mean, we talk about the Magnificent Seven, I guess we talk about it all the time. Is there any indication that the market is broadening out a little bit?
So it's a great question, because in some ways, the Magnificent Seven has turned into the Feisty Five, right? So a couple of the larger companies are simply stumbling this year, not just on fundamentals, but also on stock price. At the same time, you are seeing a broadening out to other parts of the large cap universe. We're not there yet in small cap, but we are in large cap. So the industrials are doing well, healthcare is doing well, parts of consumer are doing well. So for that part of the world, it's broadening out. But that whole Magnificent Seven, I think, is going to crack apart. And now Eli Lilly is part of that as well. So that was not part of, Eli Lilly was not part of the Magnificent Seven last year. So you're seeing a broadening.
It was a time not long ago when it was all about the Fed. Are they going to cut? How much are they going to cut? How soon are they going to cut? How much risk is there in the marketplace right now about the Fed not cutting as much as we thought or hoped they would?
So let's roll that question back a little bit. The real risk is inflation. That's the risk. And then, of course, the Fed's reaction function to it. So as long as inflation stays on this downward path, the Fed can cut and can cut by June. The big risk here is what happens with CPI for February reported in March, right? If it's another hot month, then you could get some dislocation in the market. But where we stand today, I think that the Fed story is very understood. So the market very quickly went from pricing in 6 cuts to 3 cuts for this year, even as growth was better, earnings slightly better, and the market just kind of digested it. So I think as long as the Fed cuts by June, the story remains intact, which is a bullish one. It's a strong one.
So that's monetary policy. What about fiscal policy? Because there's still some money coming out of the federal government under those bills that got enacted in prior years.
That's right. So I think there's no accident to note that those enormous $2 trillion bills that came out of the administration that were passed a couple of years ago, the IRA, the CHIPS Act, the Infrastructure Act, guess when the money really starts getting pumped into the economy? That is in 2024, an election year. So we're seeing $100 billion coming in from those acts this year into the economy. And at the same time, Congress, both Democrats and Republicans, are passing a tax bill that also bring fiscal stimulus into the economy in an election year. So I'd say that what that tells me is as the year goes on, it's going to be harder to get the recession because the fiscal policy is working towards growth. And so with that, I think that the risk of a recession that folks still worry about because of the tightening of policy and the retraction in bank credit to the economy, it's being offset by the fiscal into the economy.
So the economy's doing great. The markets are doing great. There are a few geopolitical problems around the world. We've got a war still going on in Europe. We've got a war in the Middle East with Gaza and Israel. We've got tensions in Asia. Who knows what's going on with Iran at any given time. I know that historically markets don't discount geopolitical risk very well. But at some point, do they have to start thinking about it?
So, we talked about this earlier today, which is for the most part, markets ignore geopolitical risk. And a lot of analysts talk about it, and then it goes nowhere in the story. I think this is an interesting year because if you think about the post-Berlin Wall world, it was peaceful, it was lower inflation, it was a time when, the Western world really became wealthier, as did emerging markets because there was integration and globalization. Where are we today? We look to be fracturing. We look to be going back to a place where there are blocks, there's competition both militarily and economically, and for that, you have to go back past the Cold War, because the Cold War was essentially two blocks. And we're going back before that. I'd say ultimately, if you want to think of it this way, the U.S. is really involved in a two-front war right now. Right. And the question is there a third one? No. And I don't think we're going to get past this with no reaction from markets. You could just see it might not be great. It'll be inflationary as well.